Hey class, welcome to the chapter 5 handout 2 answer sheet. So let me get those pulled up here. Chapter 5 handout 2, get my screen shared with you. And we're going to talk about some of the other issues and problems that arose in chapter 5. So our first question here, Hannah purchased a laptop computer. It's been outstanding for over 180 days. So obviously they're using the aging of accounts receivables method because they know how long it's been outstanding. They determine that that amount is uncollectible and writes off all Hannah's debt. Hannah later receives a windfall and pays the amount of her balance to PariCorp. Seems like some of this, it's missing some part of the question here, huh? Okay, because it says it's recorded a receipt of 450, not the whole 1,500. All right. So we're going to add something to this question here. We're going to assume that Hannah paid $1,050. Okay. But what was left was the 450 that they never collected. All right. Let's go to the journal entry here. On the date of the sale, okay, we're going to kind of just put it all together here. On the date of the sale, we're going to say accounts receivable and sales revenue for the $1,500. So we're going to assume that she paid off $1,050. So when that payment came, we would debit cash and credit our accounts receivable here. We can go down by the $1,050. Now, if we're looking at our accounts receivable T account, we have 1,500, 1,050. So we are still owed $450. After they did the aging of the accounts, found out it was so old, they do not think they're going to collect the remainder of this off. So that's when they record their bad debt expense. Okay. For the $450. We did that on estimate. Now, when they have a late payment come in, okay, well, actually, I need to do something else. Don't worry about that bad debt expense entry. It had already been made. So when we knew, when it went into default, okay, when the account goes into default, now we know that we're not going to collect it. We decide that it's known to be uncollectible. We would debit our allowance for doubtful accounts and credit our accounts receivable for the $450. And if there was a late payment, the first thing we had to do is reverse this entry. Okay, for $450. Reversing what we did when we defaulted it. When we said it was no longer collectible, now it is collectible, so we just make that adjusting entry. As you see, it went back into accounts receivable. But then it's coming back out of accounts receivable in the very next entry. Okay, so you need both of those journal entries. I know it'd be tempted just to, since the accounts receivable kind of cancel each other out, one's debit, one's credit, same amount, that account's not really changing. It'd be tempted just to debit your cash and credit your ADA, but you need to make both journal entries there when they receive the late payment. First one, putting it back into the account allowance for doubtful accounts and adding it back to the receivables and then taking the amount out of the receivables and accounting for that cash. All right, question 2 here. Jared's Meat Shop doubles as a butcher sandwich shop. The individuals in the hospital system, they had cash sales of 450, credit sales of 600, sales on MasterCard of 657, and sales on Visa of 923. And then we have some merchant charges from the credit card company, prepare a journal entry to record the sales. Okay, so we had some cash sales and credit sales. Remember that the MasterCard and the Visa, they are going to count as cash sales, but we're not going to receive all the cash because of those service fees. But one thing that we do know that if we took, well, isn't that weird? If we took all 3 of those together and we added them up, that amount is going to be our sales revenue. 50 plus 600 plus 657 plus 923. So 2,630 is our revenue. So when we go to make the journal entry to record these, our credit entry, our sales revenue is going to be 2,630. Okay, so then we look at the MasterCard and the Visas. MasterCard had 657 in sales, and the Visa had 923. Well, we take the 657, multiply it by 1.6% or times 0.016. We're going to round off. We're going to say there was a 1050 fee. For the 923, it was 1.9%. So take the 923 times 0.019, 1.9%. And I'm going to round it up to 1750. So these are our fees. When we add those two together, we get $28 total in fees. And of course, these are rounded numbers to make it easier for our journal entry. Okay. If 657 so there's a total of $1,580 in credit card sales, $28 in fees. So that means the 1,580, then you subtract out the 28. That means from the credit card sales, we can record 1,552 as cash, and we have to record the other $28 as service fees or credit card fees. Okay? You can add that to the 450. So our total cash received here is this, 600 in accounts receivable, because it was on credit. Okay, 28 in fees should equal our 2,630 in revenue. So we can go plug these into a journal entry now. So our cash increased in 1992. Our accounts receivable increased by 600. And we had an expense. The service fees, those are a business expense. Expenses normal debit balance of $28. Give me a second, I did something wrong here. This math is bad. It's not 1992, it's actually 2002. That's what I get for trying to do math in my head. Maybe some of you watching at home caught that. Hats off to you. Erase that, and we'll put the 2002 in here. It was just bad math. And then our credit is our sales revenue of 2630. So we put it in the credit, and if you add them all together, it would balance. And you see, that's how I found my mistake there. I added the 1992, the 600, and the 28, and I was coming up with 2620. And I knew that my sales revenue was 2,630, and then we had to balance out somewhere. So since we were not balancing, I knew I had to look back at something that I had done previously. And when I started looking through, I just realized that I added up the total credit cards, cash plus the cash sales actually, and I made a miscalculation there. So that's how knowing that your journal entries must balance. When they don't is a good double check and a way to go back and re-look over a problem and find out something you may have messed up on a simple calculation. All right, so finally here, American Enterprises uses stupid systems to implement a cash management system. They cannot pay for it out of pocket, so they are going to sign a note to pay for these services. So on January 1st, the service is complete. And for $27,000, how do we record the service performed on that day? So when our service is performed, that's when we get our revenue, service revenue or sales revenue. I signed a note to pay for it this time, original agreement, so we will create a notes receivable instead of an accounts receivable in the amount of the services provided, $27,000. Simple first entry. Does not say how long the note's for, so here we're going to say the note is repaid on May 1st. Okay, so January to February, February to March, March to April, April to May. It is a 4-month note. Okay, important to know that it is 4 months from January 1st to May 1st. Okay, so they're going to have to pay interest for 4 months. So to calculate our interest payment, we take our principal, 27,000, multiplied by 6% of 0.06, multiplied by 4/12. Because it's a 4-month note, 12 months in a year, notes are giving you an annual percentage rate. So the total interest that they need to pay back totals $540. That is their interest amount. Okay, so determine how much interest we will receive if the note repaid is on the 1st. 4 months, they will receive $540 in interest. And now the journal entry. So when we receive money for this note, okay, we're receiving cash. But we're not just receiving the 27,000, we're receiving the 27,000 plus the 540. They no longer owe us anything, so we can remove the note receivable that we created when we made the sale. And since it is over, if they account for the interest, account for 540, that is called interest income. You may also term it as interest revenue if your book goes with interest income now. Okay, so that's how you account for a note. The only tricky thing that comes with notes that you might see in your homework is sometimes a reporting period comes in the middle of the note, so you have to make an adjusting entry and accrue that to get the interest income in the right period, and then you would just have an interest receivable also included if you had to do that accrual entry. Okay. So hopefully these 4 videos I've made here on chapter 5 can get you through it. If you have any questions, as always, please do not hesitate to reach out to me. I'll do whatever we can to make sure you're understanding this material. And as I said, beginning of chapter 4, I know we're moving really fast. I appreciate everything y'all are doing in order to keep up, getting the homework in on time, getting the test done when it's required, stuff like that. This 5-week class can be rather overwhelming, and you're all doing a great job. Keep it up.